Hi, we're going to go through exercise 6-15A. This is simply doing the journal entries for inventory transactions. So we won't dwell too much on it, but it's important you understand. So we're going to start with requirement 1, which is to journalize the company's inventory transactions for the year. So the first entry we're going to do, there's two sets of journal entries we do. So for requirement 1, the first journal entry is to record the purchase of inventory. The purchases of inventory, it gives us in the table, I've circled it with red, so 46,000, there's our purchase. So we're going to increase inventory, it's an asset, a current asset, for 46,000, and then our credit will be to accounts payable. And the reason it's to accounts payable is because it told us up in that box that inventory was purchased on account. On account means accounts receivable if it's our customer, but in this case it's accounts payable because we're purchasing the inventory. When it says purchases of inventory, that means this company purchased it. So we debit inventory, an asset, and we're increasing it, and we credit accounts payable, a liability, and we're increasing that as well. So that is the first journal entry for requirement 1. We're not done yet. We also need to record the sales of inventory. Now this is a two-part journal entry. The first are two separate journal entries. So we're still on requirement 1, but we're doing the second set of journal entries, and this is for the sales. So the first thing we're going to do is record that sale. Now, it tells us in the box that we sold inventory. 17% of our sales were cash. So I've circled the total sales, 75,000 in green, and it says 17% are for cash. So if we take 17%, the thing that I've circled in red, so the 17% times 75,000, that's going to give me 12,750. So that's the amount of cash. Now, it tells us 83% of the inventory sales were on account. So this is where accounts receivable comes into play. So the 75,000 total sales times the 83% on account gives me 62,250 as my increase to accounts receivable. So my sales were in two pieces. I had cash sales of 12,750, so I'm going to debit cash, and I had the rest of my sales were on account, so I'm going to debit accounts receivable for the 62,250. Now, my credit is to sales revenue, and that's for the total sales of 75,000. So that's the journal entry that reflects the sales to our customers. We also need to do a journal entry to reflect that we no longer own this inventory, and that is for the cost of the inventory. In that same line that it gave sales information, it also told us the cost of the inventory was 39,000. So I'm going to debit cost of goods sold for 39,000. And I'm going to credit inventory for 39,000. So I'm increasing my expense for 39,000 for cost of goods sold, and I'm going to credit inventory, which is an asset, and I'm reducing inventory for the cost of that inventory that I sold. So those are the three journal entries. We had one on the last slide and two on these. That's requirement 1. So now let's go on to requirement 2. Requirement 2 says to report the ending inventory, sales, cost of goods sold, and gross profit on the appropriate financial statement. So let's go through there. I've got them all on one slide. Okay. First thing, the first part where I've got balance sheet, the inventory goes on the balance sheet under current assets. Okay, remember the top thing on a balance sheet is going to be cash. So this is just telling you the categories, it's not giving you the statement. So this is just partial. Now, 17,000, where did I get the 17,000? Well, I started with the beginning inventory I was given of 10,000. I had a debit to inventory in journal entry 1. So two or three slides back, I had a debit to inventory for 46,000, so I'm going to add that in. And then I also had a couple slides back in journal entry 2, I had a credit to inventory for 39,000. So I'm going to take my beginning inventory that they gave me, plus that first journal entry where I debited inventory for 46,000, minus the second journal entry where I credited inventory for 39,000, and that's where I come up with the ending balance of 17,000 for inventory. Okay, so then moving on to the income statement. The income statement is going to have our sales revenue on it, which is directly from the table, the 75,000 sales revenue. We're going to subtract cost of goods sold, which is the 39,000 that's given to me. And then I'm going to end up with my gross profit of 36,000, which I get by taking 75,000, subtracting 39,000. Gross profit, by the way, can also be known as gross margin. So that's it on exercise 6-15A.